Look, we're constantly bombarded by chaotic financial noise, right? But what if we could just cut through all of it? Today, in this explainer, we're going to synthesize the undeniable mathematical truths of wealth building into a single, cohesive blueprint. We're looking at the actual, undeniable math behind the decisions that shape your financial life.
Here's our roadmap for today. We're looking at the order of operations, income versus equity, choosing your vehicles, the timing trap, the invisible engine, and finally, my personal favorite, the catch-fire moment. Let's dive right in.
Starting with step 1, the order of operations, building the foundation. We absolutely have to secure this base before anything else, because skipping steps here, it costs you real money.
So, sequence matters way more than instinct. It all starts with a quick $1,000 firewall. Why? To prevent panic selling your assets later. Next up, you want to capture the 100% instant return of your employer match. That is literally free money. Step 3, crush that high-interest debt. Because honestly, no investment is going to reliably beat a 20% credit card drag. Only after that do you start loading up your tax-advantaged accounts, before finally capping it all off with a full emergency fund. If you get this sequence out of order, you are leaving guaranteed money on the table.
Moving on to part 2, income versus equity, the river and the reservoir. This concept right here reveals exactly why people pulling in massive salaries can still end up going completely broke.
Think of a massive salary like a really fast-flowing river. Sure, it keeps you alive month to month, but if you spend it all as it comes in, it runs dry the absolute second you stop working. True wealth, though, is the reservoir of equity you build. These are the assets that yield roughly a 7% real return after inflation, paying you while you literally sleep. The entire game of finance, it's just converting your river into a reservoir before you run out of time.
All right, part 3, choosing your vehicles, accounts, and assets. Because the accounts and assets you pick behave very differently under the hood. Take Maya, for example. She's using a traditional 401k. She gets a nice tax break today, but she's facing a massive, totally unknown tax bill decades down the line. It's a bit of a tax illusion, where her balance looks way bigger than her actual spending power will be. Then you've got James. He uses a Roth IRA, so he pays his taxes up front today. But think about this. If you expect the national debt to force tax rates higher over the next 30 years, James just bought himself tax immunity. His future withdrawals are 100% tax-free. Pretty huge, right? And when we switch over to physical assets, the rules totally change again. Jake buys real estate. He gets this massive 5-to-1 multiplier thanks to mortgage leverage, which is great. But let's be real, it basically functions like a demanding second job. On the other hand, Marcus buys gold. Awesome for crisis protection, but it produces absolutely no yield, no rent, no dividends. During flat years, inflation just quietly eats away at his purchasing power.
There's a really great saying for this. Gold is armor, and real estate is a machine. Think about it. You don't wear a machine into battle, and you definitely don't put armor to work out in the field. You've got to know the exact job description of the asset you're buying, rather than just going all in on one and hoping for the best.
Now, when it comes to the stock market, boring mathematically defeats brilliant every time. Warren Buffett actually made a famous $1 million bet that a totally hands-off passive index fund would beat a team of elite, super expensive hedge fund managers over 10 years. And guess what? He won in a massive landslide.
So why does indexing work so incredibly well? Well, a century of data reveals a pretty shocking truth. Just 4% of stocks drive the market's entire net wealth creation. The other 96%? They essentially perform like boring treasury bills. So by buying the whole haystack, you guarantee that you own those rare needles, all without paying ridiculous fees to a manager who is, statistically speaking, going to fail to find them anyway.
Which brings us to part 4, the timing trap, the myth of the perfect entry. Let's zoom out to look at the psychological traps that completely derail otherwise perfect strategies.
Okay, we've all felt this. It feels absolutely terrifying to put money into the market when it's never been higher, right? But what if you only invested at all-time highs? Listen, waiting for a dip is really just market timing dressed up in a cheap tuxedo. Research from Archbridge proves that historically, investing at all-time highs actually produces higher average returns than holding cash and waiting for a 10% pullback. Sounds crazy, I know, but why? Because all-time highs cluster together during massive economic expansions. If you sit on the sidelines, you might miss the market's 10 best days, and the data shows missing just those 10 days over 20 years cuts your total returns by more than half.
Dollar cost averaging just consistently beats trying to time things, period.
This whole fear of missing out, it breeds some really dangerous manias. Think of the famous 1929 shoeshine boy giving stock tips, or the 2006 Vegas waitress buying 5 condos with zero income. There's a term for this: reflexivity. It's that crazy moment when an asset's price completely detaches from reality, driven purely by the herd mentality, that someone else will just buy it for more later. Recognizing this psychological loop is exactly how you survive a bubble.
Moving on to part 5, the invisible engine, the bond market. Because while stocks always get the flashy headlines, the $130 trillion bond market is what actually dictates reality.
There is this inescapable inverse relationship right at the heart of global finance. When central banks raise interest rates, the price of old bonds comes crashing down. Think about it. Why would anyone want an old bond paying 3% when a shiny new one pays 5%? They wouldn't unless that old bond goes on sale at a steep discount. This exact mathematical trap is literally what collapsed Silicon Valley Bank in 48 hours. Now apply that exact same math to the U.S. national debt, which is sitting at over $33 trillion. The era of near-zero interest rates is officially over. That means this massive pile of debt is rolling over into much, much higher rates. It's projected to cost $1 trillion a year just to service the interest. You better believe the bond market is watching this extremely closely.
Because the bond market really acts as a global voting mechanism. When the smart money gets scared, investors flood into long-term bonds, and that pushes long-term yields below short-term yields. This is called a yield curve inversion, and it is the financial system's ultimate warning siren. Seriously, it has reliably predicted every single U.S. recession since 1955. If you don't understand bonds, you kind of don't understand money.
Finally, we reach part 6, the catch-fire moment, the math of compounding. Let's bring all of this together by looking at the absolute ultimate lever of wealth, time.
Just look at this comparison for a second. An early saver who puts in a total of just $18,000 over their first 5 years absolutely crushes a late saver who scrambles to invest $54,000 over their last 15 years. We're talking ending up with roughly $123,000 versus $95,000. Time compounds so much harder than money ever could. Literally every single dollar you delay investing loses its most powerful asset, decades of runway.
Let's put a real number on it. If you're investing $300 a month, your catch-fire crossover line is exactly $51,400. Why that number? Because at that point, a historic 7% real return starts generating about $3,600 a year. Boom! The market is now completely matching your own paycheck contributions. The massive tragedy here is that most people hit this line around year 10, which is the exact moment they get bored or frustrated and just quit. They walk away right before the math completely flips in their favor. So listen, survival is the entire strategy. Whether it's picking the right accounts, avoiding the timing trap, or just trusting the compounding process, your only real job is to never step off the line. So run your own numbers. Where is your crossover point going to be? And when you inevitably hit that frustrating middle stretch, will you have the patience to let the fire catch?